Hey there, and welcome back to another episode of Broke Up Not Broken. I'm your host, Jamie Lima, a certified financial planner and certified divorce financial analyst, and the owner of a company called Allegiant Divorce Solutions, where we help people better prepare for, navigate, and recover financially from divorce. If you're going through a divorce, don't worry, you are not alone. This is your one-stop shop for mastering your finances through the entire divorce process. In today's episodes, we're talking about marital assets and debts and division strategies around them. So whether you're just starting to consider a divorce or you're in the thick of it, this episode will equip you with the knowledge and tools that you're going to need to divide up assets in your divorce properly. So grab a cup of coffee, your beverage of choice, whatever soothes you, buckle up, and let's get financially empowered in today's episode. Again, I'm Jamie Lima. I'm the host of this particular podcast and the founder of Allegiant Divorce Solutions. We work with people all over the country in a 100% virtual setting to help them better prepare for, navigate, and recover financially from divorce. I am what's called a certified divorce financial analyst and also a certified financial planner. I've been a financial planner for almost 20 years now. And divorce is one of those things that we deal with all the time. And this is one aspect of divorce that people tend not to understand, even though it would seem that it's a common a common aspect of divorce that people would want to get wrap their heads around. They just don't. People just don't understand how to divide up assets properly, and they don't understand the tax impact of dividing up assets. They don't understand what the process and procedures. They don't understand the strategy alone. And this goes for divorce attorneys as well. We work with a lot of divorce attorneys when we present solutions to them and different strategies that our mutual clients can use. And they just don't get it, and it's not their fault. They're not experienced in the world of finance, and they weren't necessarily trained or educated on this stuff. So we're going to break it down for you. We're going to talk about marital assets and debts, different ways that you can divide up the assets, how to classify them and what the classification means. And I think all three of these key topics are going to go a long way in helping you as you start to go through the process of divorce. So let's start with marital assets and debts, right? What is marital property? Well, marital property are all the things that you accumulate during the marriage. Seems pretty simple, right? There's premarital assets, maybe stuff that you owned before, maybe your car or a 401k that you had before you got married, or an IRA, or other assets that you owned before you got married. Then you said, I do, and you contributed to your 401k, you put money away in a savings account, you bought a house. Those are all marital assets because they came after I do. Now, you decide that you want a divorce. In most states, when you decide that you want a divorce, you have to file divorce paperwork with the courts. That usually becomes your separation date when you've actually filed for divorce. And that date is incredibly important because that's when the clock starts ticking on post-marital assets, right? So you accumulate stuff before you get married, you say, I do, and then you accumulate stuff during the marriage, and then you say, I don't. And whatever happens with those assets after are basically completely separate, right? You want to make sure you understand what your date of separation is, because that's a huge part of all the calculations that we're going to run as financial analysts. We're talking specifically about marital assets, though. So how is separate property treated in divorce differently than marital property? Well, separate property, we've already talked about this, is stuff that you accumulated either before you said I do or before you said I don't. In many states, those assets are yours and they are sole and separate from the marital assets. And you want to make sure there's a clear line of delineation between those assets and the marital assets. You want to make sure that you have separate accounts, you handle them separately. The other person in the relationship doesn't have access to those assets. You want to do whatever you possibly can to keep them separate and not commingle them with marital, and then they could potentially become marital assets later on. And I'm going to share a little bit about what that all looks like here in a minute. How do we divide up those assets in a divorce? Well, each state has different laws by way of which assets are divided. Most states are what are called equitable distribution states, where this simply means that you're going to divide up your assets in such a way, and your debts, mind you, you're going to divide up this stuff that you've accumulated during the marriage in a way that is fair and equitable. Now let's talk about what's fair and equitable. Fair and equitable does not mean 50-50. It could be 45-55. It could be 60-40. We worked on a case one time where there was such a disparity in the earnings capabilities of this one spouse versus another, and they had accumulated a lot of stuff over the years. Multiple homes, cars, vacation homes, all the stuff, right? They accumulated all that stuff. The husband was making somewhere around $500,000 a year. The wife was a stay-at-home and didn't make any income. Didn't have any income coming in. When we went through mediation and the divorce was finalized, they agreed that he was going to give her everything except for, I think there was one vehicle and he had an apartment. He had an apartment that he was going to stay in, and there was one vehicle in the apartment. In most scenarios, the courts would not approve that because it is not fair and equitable. But once we made the argument to the courts of this is why it is fair, right? Because he knew that within 5 years, he could reaccumulate all of these things because of the earnings capability and earnings power he had. So once we made that case to the courts and said, listen, Your Honor, in 5 years, he's going to be right back to where he started from, and she doesn't have the ability to go out and earn enough wages or have enough income coming in to be able to buy all these things and maintain some semblance of the lifestyle that they had. So he's willing to give her that because of this. And that was perfectly fine. So that is an equitable distribution in the eyes of the court. So it's fair and just, not necessarily equal, right? That is the most common approach in many states. And it's very, very difficult to show what's fair and equitable without the proper use of financial analysis, which is the type of work that we do. Community property is the other big one. There are several states throughout the country that are considered, they basically divide up marital assets 50-50. I'm in the state of California. California happens to be one of them. Unless you can make a solid argument for the reason why there wouldn't be 50-50 split of assets or liabilities, debts, credit cards, auto loans, student loans, those types of things, you're probably going to split things 50-50, right? A lot of things are taken into consideration relative to the marital property and how they're divided. First off, it's the state you're in. Right? The states are sometimes going to dictate how things are divided up. What also comes into play are things like the length of the marriage, right? The financial contributions of each spouse. In my example earlier of the gentleman who was able to earn a significant wage and replace all the things that he was going to give up, that would be taken into consideration. Any of the needs of the children, in my opinion, this is first and foremost, and this is the one thing that the courts look at. The number one thing is how are the kids going to be affected in the divorce? And there's also any non-marital property contributions, right? And this is kind of tying into asset valuation and classification. But if you take separate property and make it community property, it can have a significant impact on how things are divided up and whether you're actually going to be able to claw that back when things are separate. For example, let's say you had separate property and you put money you pitched in money out of that separate property to buy a vacation home. Well, when that vacation home is sold, depending on how we negotiate, you may be able to carve out some of that, the growth in that asset, along with the contribution that you've made to the vacation home. You'll be able to get that back as part of your sole and separate property in the settlement of the divorce. Happens all the time. It's not that complicated, but if you don't know what you're doing here and you don't know how to run the calculations, it can get a little tricky. So that leads me to the next section, the next point I want to make, which is accurately valuing marital assets. This includes your house, your investments, your retirement accounts. If you're one of the few that still have a pension, you have to make sure that you value all of these the right way to ensure a fair division. You have to get an appraisal for real estate. You probably want to get a business valuation done if you own a business. We do this all the time with our clients. We have somebody we refer people out to do business valuations because we want to make sure we're understanding the true value of a business. And that is very, very important in divorce. You want to look at the market value of your investment accounts. And there are specific rules in which you can divide up retirement accounts and when you can gain access to them. For example, a pension. If you have a pension, you might not be able to access that account until the age of 65. And that could be 20 years into the future for some of you. Right? You want to make sure you put a value on that asset, even though it's not something you can even touch you can reach out and grab money from. You have to be able to put an evaluation on that. And that's one of the areas we actually specialize, which is pension valuations and running people through those calculations, because it can get a little tricky. I cannot stress enough how important it is to gather all of your relevant documents pertaining to this stuff. So before you drop the D word, you want to start gathering retirement account information, pension information. If you had an appraisal done on the house, you want to get that information, tax returns, all the stuff. You want to know how much money you inherited, if you received an inheritance, how you use those assets. Remember my example just a short while ago about taking some money out of your separate property and buying a vacation home with your spouse and creating this quasi-marital community property scenario. You want to make sure you have all those records and start gathering those documents, and just document the best you possibly can, because that is going to go a long way in helping you with the negotiation piece. It's all about ensuring you can prove who owns title to things and really trying to validate the argument that you're trying to make, right? So we covered a lot in a short amount of time here, but I really just want to drive home a couple things, right? You have to understand the difference between marital assets, premarital, marital, and post-separation, or the after the I don'ts asset, right? You want to make sure you understand how that all works, when the clock starts ticking on all those, so you can get an understanding of what you might be left with when all is said and done. You have to understand how your state in particular divides up these assets by rule. And then if is it a fair and equitable state where you want to make sure you have to prove there's equity in the decision that you make and it's fair? Or are you in a community property state where basically everything's going to be 50-50, and it's usually pretty straightforward. The length of the marriage, the children, all of that stuff is involved in these calculations. So you have to make sure you get this right. I would encourage you to make sure you can prove the value that you have for all of these assets and your liabilities. Credit card statements, bank records, appraisals, business valuations, pension statements, all of it is incredibly important to lay it all out on the table and to create a balance sheet for yourself and be able to show the courts why you deserve what you're aiming for in the settlement. I hope this was helpful. I really do. This is an incredibly important topic, and we're going to be touching upon this and these topics in consideration of all intertwined, I should say, within all the other conversations we're going to have as we move forward. We're going to have special guests that are going to be talking about this stuff. I'm going to be talking about it. So this is just the tip of the iceberg, and just to give you a little bit of a lay of the land of how all this stuff works. I hope this was helpful. Again, I'm Jamie Lima. I'm a certified financial planner, certified divorce financial analyst, and founder of Allegiant Divorce Solutions. You can visit our website at the links in the show notes. They're right there for you to follow if you want to book some time to talk about your particular situation. If you have questions on this, don't hesitate to DM me or drop me a note in the comments below. I'm going to do my best to answer all of them. If you want to schedule a free consultation where it's completely confidential, there's no cost, there's no obligation, I'll get you pointed in the right direction. Go to the website, allegiantds.com. Schedule some time with us there, and we'll do our best to triage your situation and make sure we get you pointed in the right direction. I look forward to sharing more information with you. We have some amazing special guests coming up, so please don't forget to subscribe, like, follow, whatever it is you have to do to get updates on this. We're on Spotify, YouTube, Apple, all of it. So wherever you get your podcast, subscribe, like, follow, and we'll talk again soon.